Trumponomics. Does this mark the beginning of an economic revolution for our country? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. And what an eventful week we've had since Inauguration Day, both economically and financially speaking. The first round of executive orders from President Trump are out, and they give us a glimpse into the economic revolution that may be about to happen in our country. So, with that in mind, here are the three topics I'll be covering in today's update video. 1. Trumponomics. What the new administration has set in stone already, and what could this mean for your money and the American economy? 2. Which treasuries rose the most and which ones fell this past week? In this section, we'll also address this headline that some of you sent us. Trump demands Fed cut rates. And 3. What are the yield expectations for the upcoming week's Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? And as usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Trumponomics. What the new administration has set in stone already, and what could this mean for your money and the American economy? Trumponomics refers to President Trump's focus on tax cuts, deregulation, trade protectionism, meaning tariffs, and infrastructure spending, and of course, his stance on immigration and keeping America first. As promised, Trump issued a flurry of executive orders on day one of his second administration, which taken together may have an impact on the U.S. and global economy that could amount to a veritable revolution, as these executive orders seek to break with many economic policies of the recent years. Here are 7 key themes of the executive orders issued to date. Tightening of immigration policies, including deportation plans for illegal immigrants and shutting down the border. Encouraging oil and gas production in the U.S. Trump referred to this as liquid gold in his inauguration speech. Establishing the Department of Government Efficiency to bring down spending. He has also broadly directed all executive agencies to tailor their policies to reduce consumer prices. Eliminating government DEI programs, diversity, equity, and inclusion programs, and requiring all federal workers to return to the office full-time. President Trump has given executive branch departments and agencies 60 days to eliminate their DEI programs. Creating a cryptocurrency working group to look into crypto regulations and study the possibility of setting up a national stockpile of digital assets. Not surprising given that he has his own meme coin now. Withdrawing the U.S. from the Paris Climate Agreement. Pausing the U.S. ban on TikTok for 75 days while the search for an American buyer continues. Also noteworthy was that Trump ended the previous administration's policies on supporting electrical vehicle development and purchases and setting guardrails on AI development. So, for those of you who've been following our videos about the new administration's proposals in recent weeks, there is one big, flashing economic topic that has been so often talked about since before the election that does not appear on this list. And no, I'm not referring to Social Security or Medicare this time. It's tariffs. While Trump did order the establishment of an external revenue service to collect tariffs, duties, and other foreign trade-related revenues, he did not impose any new tariffs on day one. Rather, he only directed the government to begin reviews of the U.S.-Mexico-Canada Free Trade Agreement, NAFTA, the causes of U.S. trade deficits, and the U.S. trade dealings with China, among other areas. So, no new tariffs yet, but Trump also didn't retract his threats to impose tariffs as high as 25% on imports from Canada and Mexico and 60% on imports from China either. Even without tariffs, though, these executive orders here sound like a major change in the making. And coincidentally, this week was also when many political, business, and financial leaders from all around the world convened at the World Economic Forum Conference in Davos, Switzerland. Needless to say, these executive orders shocked quite a few in Davos, perhaps because they didn't actually think Trump would follow through on some of his more revolutionary campaign promises. But after they had overcome their initial shock, enough of these leaders also seem to like the direction this is taking, at least for the U.S. As the Wall Street Journal summarized the Davos perspective, Trump's arrival brightens U.S. outlook. darkens everyone else's. Bankers, government officials, and CEOs at Davos see his deregulatory, energy, and tariff policies sucking investment from other regions and hurting their exports. Trump took time to speak to the Davos crowd himself by video from DC and bluntly told the Davos crowd that they should invest in the US or face tariffs, and that he wants lower oil prices and interest rates as well. More on the interest rates later in this video. Apparently, as Business Insider reports, the stunned audience at Davos went from laughter to silence in seconds. And by the way, on Thursday already, Saudi Arabia said that it will increase U.S. trade and investment by $600 billion. Of course, in his usual fashion, President Trump said he would ask the Saudis to round out their promised $600 billion to around $1 trillion. As many of our Diamond NestEgg regulars know, we have been of the opinion for quite some time that America currently seems to be in a good place, economically speaking. And what we can see from these first executive orders taken together is this: they very much follow an America First theme. And if implemented properly, good strong doses of productivity, meritocracy, and investment in our country may mean that we will be even better positioned to continue down our economic path of growth going forward. And it seems the financial markets agree with our, as well as the Davos crowd's upbeat assessment of bright prospects for America. As of the close of market Friday, the S&P 500 is up 2.76% over the past 5 days. Although I should add that this was also helped by a strong start of the current earnings season in the last few days. So equity markets, which are practically always trying to predict the future, seem to imply that the U.S. economy should continue to perform reasonably strongly and avoid a hard landing or recession, at least for the time being. But we are a bond channel at our core. So let's move on to the next section of this video and talk about those tariffs that were not announced this week, as well as inflation and Trump's pressure on the Fed to lower rates. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. Remember that January 17th was the last trading day before the inauguration. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. So, despite all the excitement around the inauguration of the second Trump administration, Treasury markets had actually a very calm and uneventful week in the end. The 6-month and 1-year were down slightly by 3 and 4 basis points respectively. The 4-month, 2-year, 3-year, and 20-year were literally unchanged, not a single basis point difference. And all the other maturities were up, but again, only very slightly, which seems to imply that bond markets have been pretty unfazed by the new administration, so far at least, and that they are probably also preparing for rates that will stay higher for longer, despite the fact that Trump demands that the Fed cut rates. And for those of you who've asked, no, Trump cannot just demand that the Fed cut rates. The Fed is independent by law, and only the Federal Open Market Committee will decide what rates we will see. It's no secret that the president and Fed Chair Powell have not always seen eye to eye on some matters, to say it nicely. But at the end of the day, the Fed has a dual mandate of keeping both inflation and unemployment at bay. And this will not be an easy task if Trump does decide to impose blanket tariffs across the board, as suggested during his campaign, because such a move might lead to higher prices for imported products, a tariff war, and the possibility of rate hikes to fight the ensuing inflationary pressure. So forget rate cuts in this instance. But as we've talked about often on this channel, if tariffs are merely a tool for negotiating better trade agreements with our partners, or used on a selective basis, which seems to be the initial direction Trump is taking in these early days, the current tariff-driven inflationary concerns may be a bit overblown, especially if Trump's economic revolution brings on further growth for our country. Increased economic growth may also help with the budget deficit, assuming the spending does not grow proportionately with revenue. And while there are quite a few ifs involved, the point is that a growing U.S. economy is generally good news for those who live, work, and invest in our country. Of course, at this point in time, it's still too early to tell, but as always, we'll keep our eye on the ball and keep you posted as the situation evolves. So, as many of you know, at this point in the video, we typically compare Treasury yields from this past Friday to the beginning of the year. But since it is still the beginning of the year, we'll look at Treasury yields from this past Friday versus the same day 1 year ago in 2024. This row shows where rates ended this past Friday. This row shows where rates were on January 24th, 2024. And this row shows the increase or decrease in rates over the past year. Again, increases in rates are shown in black and decreases in rates are shown in red. Treasury yields across all maturities 3 year and up are noticeably higher than where they were a year ago, with the biggest differences to be seen on the very long end here. Everything 2 year and shorter, though, is lower than where it was a year ago, with the biggest differences to be seen on the 1 to 6 month T-bills due to the Fed's rate cuts last year. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 2-year, 5-year, and 7-year T-notes will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon is still to be determined. Also in the schedule is this 2-year floating rate note. At the time of this taping, here's what the coupon and the expected yield are for the 2-year T-note on Fidelity's platform. Here's what the coupon and the expected yield are for the 5-year T-note. And here's what the coupon and the expected yield are for the 7-year T-note. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries for this week. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one from Federal Home Loan Banks at 6.25% with a first call date in April 2025. Here's the CUSIP for those of you who may be interested. For corporate bonds at the time of this taping, there's literally nothing on Fidelity, which is very unusual. Not sure if this is a glitch, but we hopped onto Schwab's website for you, and here's where the highest yielding new issues stand at the moment. With the highest yielding one from Deutsche Bank at 6.2%, with a first call date in January 2026. This is the same one that was on Fidelity's site last week that we already shared with you. Here's the CUSIP for those of you who may be interested. For brokered CDs, the highest yielding one on Fidelity is again from CFG Community Bank at 4.75%, with a first call date in April 2025. If you know of any bank CDs or high-yield savings accounts with particularly attractive rates at the moment, please do drop them below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to build a stable, predictable income stream in retirement, especially while bond yields are quite attractive, then check out this video here on our bond courses, which we are in the process of updating. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of January. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or our intermediate level course, Bond Masters, individually. And as a reminder, our next YouTube member live is this Sunday, January 26th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into the upcoming week's 2, 5, and 7-year Treasury auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.